when you look at VIP Industries' announcement of the 32% stake sale, or as this line suggests, right, the promoters packing their bags, not literally really, but it tells you, it begs you to think of what could have led to something like this. Why would a promoter entity sell out in a nation which is starting to move around and holiday a lot more? So the news first, Dilip Piramal and group are selling about 32% stake to multiple private equity investors, including multiple PE, by the way. So that's the first piece, that's the news. There will obviously be an open offer that will follow for the public shareholding. And this 32% stake is being bought at a point of time wherein the company in 2025, FY25 actually, let me put it this way, ended at about 4% EBITDA margins and trades even right now at a over 65 times EV EBITDA multiple. I mean, the valuations at which VIP Industries trades at is actually pretty steep, even at these valuations. So what could have led to this? There are 4 or 5 things that I thought were key negatives over the last 5 years, which could have probably led to this. Firstly, profitability and operating margins have been hit for sure. So the consolidated EBITDA moved down from 331 crores in FY23 to 82 crores in FY25. Naturally, operating margins would also have corrected, so let's get that number going as well. The operating margins fell from 15.8% in FY23 to 4%. I mean, can you imagine this drop really? It's really been tough. There has been aggressive liquidation of slow-moving inventory with substantial price discounts, which leads to operating margins cracking, naturally so. And there are structural channel mix shifts away from high margin offline to lower margin online. This will be true for the industry, but for VIP as well, it's turning out to be true. There is high and persistent inventory for VIP all through, which leads to this liquidation, right? So this is the other big one. Inventory is leading to cost overruns and debt buildup for the company. The working capital debt rose to a peak of 533 crores in March 2024. And even as of March 2025, I think it was at 415 crores. And the debt equity ratio, despite this peak debt coming off, is about 1.2 times still, which is very high debt per se for this industry. Market share loss is the third big negative for VIP Industries. Now, think of this. The market share has dropped from 48% 5 years ago to 38% as of March 2024. I haven't included the FY25 or March 2025 numbers because they're not available as yet. But I'm presuming that with the fact that their margins have come off and they've tried to push the inventory but not quite succeeded, the market share would be lower than 38% as well, but that's a presumption. Other thing, management issues. I mean, the company's consistently missed its own margin and growth targets. In fact, in the latest con call, the management said that despite our talks in the past, now the new margins that have come in are the new normal. Also, the CEO churn is very high. I believe from FY21 to FY24 or 25, they've probably had 3 or 4 CEOs, and that's not great news as well. And the ratings, I mean, just recently, by the way, I think as of June 2025, CRISIL has downgraded the long-term rating outlook from stable to negative. As I said, in FY25, and the numbers just came out. I think the data just came out recently. They've cited margin slowdown, working capital pressure as one of the key reasons why the ratings have come off. And they cite the risk of prolonged competitive price pressure. And this shouldn't surprise anybody. So multiple reasons why VIP has been sluggish of late, and maybe which is why the promoter entity would have felt that it's better to hand it over to somebody else who can possibly manage the show better.